All right, welcome guys to Option Trading Bootcamp session number 5. And I'm going to do a screen share here and we'll hit the ground running. So as you guys know, we're learning one trade a week and we're in week number 5. So far we've learned about selling naked puts and covered calls and selling naked puts and turning that into the wheel strategy so that you can turn around and sell covered calls. We then talked about in the second week selling naked calls and then turning that into a reverse wheel. So you're selling covered shorts. The third week, we talked about poor man's covered calls, which is a bullish trade, and then poor man's covered puts, which is a bearish trade. And today we're going to talk about strangles and straddles, which is what we're going to cover today. And that is an undefined risk trade. And then next week we'll cover iron condors. And then the last week we'll cover diagonals. So just to take a look at the market this week, fear continues to relax as the market moves to all-time highs. So what typically happens when the market is going up, fear tends to relax. And that's kind of what's happening here with VIX. And when the fear was high, a lot of your theta decay got sucked up. It's kind of like Dallas traffic. And then it starts moving again. And then that movement starts, all that theta begins to come in. So our agenda, I like to start off every session is what have you learned or practiced since we last met? And you can talk about anything that took place that you learned in the leaderboard or anything that you're doing in your real accounts that you're learning and doing related to trading. So who'd like to go first?
I can.
Okay, Nancy.
Okay. I tried the setup you mentioned, I think on Slack about the SPX diagonal with the call and the put, which I tried.
Good.
And today I made, it says 590.
Nice. And did you set the long end about 2 weeks out?
Yeah, 26th March and 15th March.
Okay. And so your next roll will be on for your short leg. Is that going to be tomorrow?
Tomorrow, yes.
Okay, good. Who's next? What have you learned or practiced since we last met a week ago? Or if you missed last session, Chris, 2 weeks ago.
I see what you did there.
Okay. Yeah. This is accountability, calling you out.
Got it.
Anybody else? What have you learned or practiced since we last met?
What I learned was if your percentage is in it and it's in the right place, how many points you're in it, and you feel comfortable taking your money out, take your money out unless you want to let it ride and go into significant negative territory.
Okay.
That's just
yeah, percent in it in trade diff is the percent of the initial credit that you've collected so far. Primarily, I use that for on Strangles, which is today's trade that we're going to learn about. So I don't use percent in it for everything, but it's a good principle because Tasty Trade tends to advocate taking profits at 50% of max value. All right, who else? What have you learned or practiced since we last met? All right. Usually at this point in the day, I interpret 30 seconds of silence as meaning I got nothing. So if that's not the case, interrupt me. So our plan is to learn one trade a week for 7 weeks and to practice that during our full 7 weeks. Then what I'm going to let you do is to continue to monitor the contest for another month as we kind of look at kind of how things. So I interpret that the contest will last at least 60 days from the beginning. Today, we're learning about selling strangles. And then the accountability plan is kind of to continue to, I'll call you out on people that haven't done their homework and highlight the people that have. So what's the leaderboard look like? Here's today's Bootcamp Challenge leaderboard. It looks like James Galindo is back in first place. Oki Brock, who is my nephew, is joining us virtually, and he's in second place. Brian Hasley is in third place. I think he had some work obligations come up at the last minute. Chris Mutafov, for a guy that misses class, he's in fourth place. So, anything is possible, guys. So don't give up.
You can't lose money if you don't trade.
Yeah. Alex Uzier. Yeah. Alex Uzier is in fifth place. He was up, I think, close to around second. It looks like Ron is in sixth place. Charity, who's joining us virtually, is in seventh place. OJ's in eighth. Mike, my partner here, is in ninth, and Max is in 10th place. In terms of a bullish trajectory, I mean, this is the last 1, 2, 3, 4, 5, 6 days of the market, and it looks like it's kind of just been, a melt up. So a bullish trajectory this week. And so let's do a review. If somebody would give me maybe a three sentence description of, if somebody at your work says, hey, I hear you're going through some options trading. Hey, tell me what is a naked put? What does it mean to sell a naked put? Give me a 2 to 3 sentence description of that, someone.
You want to look for a bullish stock.
Okay.
With about a 20 to 30 delta over a 1 month period.
Okay. Now, what does delta mean?
Delta is the spread, I believe, isn't it?
It's how far away it is from at the money.
Right.
Okay. All right. So you're selling a put 30 to 45 days out to start at a 20 to 30 delta put, and it's a bullish strategy. And what are your options if it goes in the money? Anybody, and not just you, Brandon. What are your options if your naked put goes in the money at expiration?
You can roll it.
You could roll it. What else?
Buy it back.
You could buy to close, right? What else?
Pull your hair out.
Pull your hair out. Okay. That might be in addition to the first two. I don't know. There's a third option, which would be to take possession of the actual stock, because a naked put that goes in the money turns into long stock. All right. Somebody give me a 3-sentence definition of selling a naked call.
It's basically the opposite of a put.
Okay.
So it's bearish.
It's bearish.
Has all the same options. And like you said, you only want to sell these stocks if you don't mind owning them.
If you don't mind being short them.
Yeah.
Okay. So it's a bearish play. You're selling 20 to 30 delta, which means out of the money. It has like a 20 to 30% chance of being in the money at expiration. And what are your options if you sell if it goes in the money? OJ, you were going to say something?
And you actually don't own the stock. For a naked option, you don't own the stock. So.
Yeah, that's what makes it naked. The reason we call it naked is you don't actually own anything to cover it. If it would be covered, it would be either a option spread or it would be a covered call or some kind of call, right? That's a good element of the definition too. So let's say your naked call goes in the money. What are your options? Goes in the money at expiration. So you sell a naked call in Facebook at 200, and at expiration, it's 201. What are your options?
The same as the other.
Buy it.
Okay, you could either buy to close, your option.
Take possession.
You could take possession of the short. So in this case, an in the money call exercises to a short position. Or pull your hair out, right, OJ?
Yeah.
Explain a poor man's covered call.
Same, right? Wouldn't that be the same?
The same as what?
The naked call?
No. A poor man's covered call is a spread. A naked call is just selling a naked call option. So somebody explain a poor man's covered call.
It mimics ownership of the stock by buying an option very far in the money and selling an option out of the money.
Okay.
So it makes a covered call.
It mimics a covered call. And the reason it's called a poor man's covered call is it takes less capital. Buying a 70 delta call option further out in time and selling a 20 to 30 delta call closer in time. So by further out in time, you know, it's right now it's March. Let's say you bought a call option in June, 70 delta, and you sold one in April at a 25 delta. That would be a poor man's covered call. It's a bullish strategy that gives you positive theta decay. Somebody describe a 2 to 3 sentence definition of a poor man's covered put. First, is it bullish or bearish?
Bearish.
Bearish. What delta put are you buying?
70.
70. Further out in time or closer in time?
Further out.
Further out in time. And you're selling what delta?
20 to 30.
20 to 30 delta. Further out in time or closer to time? Closer to time.
Closer in time.
Okay, there you go. So let's review some trades that worked this past week. And let me look down the list. And I know there's several of folks who weren't able to join us, at least on this live. They'll probably be joining us later. So Chris.
It says here, someone is in the waiting room.
Okay, that's Brandon's job, is to help watch the.
It's not showing up. I've got somebody in.
Okay.
Everybody's in. Tommy's back.
Brandon got distracted by Kramer. Kramer's always in the department.
Let me stop the share. I don't see anybody there's nobody showing up in the weight room. Where are you seeing that, Nancy?
In a text.
In text.
Oh yeah, that was Tommy.
That was Tommy. Okay. Tommy's already here. So that was an old message, I guess. But thank you very much for watching that. Chris, so let's go on down. I won't go through all these trades that work since they're not here. They're not here to actually defend their reasoning. So Chris, you mind telling us a ZS? What trade was that?
Look, I'm really bullish on ZS at the rate that they've grown over the past couple of years.
What is ZS?
ZS is Zscaler.
Zscaler, okay.
They're a tech company, right?
Okay.
They're growing. They're providing capabilities to organizations to accelerate the delivery of software, capture information, use it effectively to accelerate the way work gets done. I've just been really bullish on them for a long time.
Gotcha. Now XME is an ETF. Are they in mining?
Yeah, they are in mining. They mine precious metals like aluminum, silver, copper, things like that. And I just, you know, I knew that as soon as we pressed the print some money button and that stipend came out, which was effectively inevitable given, you know, the current situation.
Right.
It was going to go up because demand for manufacturing for those commodities just skyrocket.
And then United Airlines, you were up 26.62. So I guess that's a travel recovery play.
Yep.
And then Pfizer, you were up 12.87. And DBC, what's that?
Those are just commodities, like food commodities, grain, corn, etc. So
Okay.
I anticipated, you know, once we press the print money button again, commodities are going to increase as well, and I was real bullish on it. So
Gotcha. So a lot of yours was kind of, let's call it the print money thesis. And then the last one is Sabre. You're up 20.80 on. So any thoughts on that one, or how did you choose that one?
yeah, look, I mean, I thought when I look back at Sabre a few weeks ago that it was very undervalued. It effectively had been cut into more than half. And I knew that once travel opened back up, Sabre, like UAL, and if I was making that bet, I may as well make it again. And just really bullish on it.
So it's kind of a combination value play and a recovery for travel. Is that right? A COVID recovery play for travel.
Yeah.
Okay. So good. So in terms of accountability, the 5-star student awards, 12 out of 22 have completed all assignments. And, you know, if your name's not up here, you might be kind of missing something. Let me know. I don't want to pressure you too much, but you know, they did years ago, they did a study of the difference between great athletes and good ones. And what do you think what the difference was?
Consistency.
Practice.
Practice.
You gotta be
The great
working.
ones fell in love with practice. So when everybody else went in, practice is over, you know, the great ones were still out there doing something. And so, you know, most people don't recognize opportunity when they see it because it's dressed in overalls and it looks a lot like hard work. So do your homework. Today, what we're going to be talking, we're kind of halfway in, is I wanted to teach you the Strangle. And I'm excited about this because this is our first neutral strategy. Now you guys have learned 2 bullish strategies, 2 bearish strategies, and now you're going to learn your first neutral strategy. So a Strangle is a neutral strategy where you're selling both the puts and the calls out of the money, 20 to 40 delta. And what you're really hoping to do is that your price stays within a particular range. So let's say something is trading at 50 and you sell a put at 20 and you sell a call at 60, and you're hoping the price stays between 20 and 60. And if it does, you keep the entire premium. It's an undefined risk trade. The higher the delta, the lower your probability of profit. So really what you're doing is you're walking this balance line between theta and probability. My favorite delta is 30. And so we're going to also talk about how to manage the trade if it goes against you. So I want to demonstrate a strangle for you. And I'll go ahead and I'm going to get out of this and I'm going to show you first in toss, and then I'll show you in trade diff, putting on a strangle. And so I think all of you guys, I have shown you kind of how a list of a watch list here. And let's look through our watch list. And what I do is I look at a high IV, implied volatility. And let me look here. And GDXJ is something.
Are you wanting to show us your trading screen?
Yeah, that's good. I didn't do that, did I? I'll
Yeah.
stop the, I'll move that over to the shared screen. Thank you, Brandon.
Yes, sir.
Yeah, there you go. So GDXJ looks like it has like an implied volatility of 44.67 and an IV rank around 45. So that looks like a pretty good candidate. GDXJ is a mining ETF. And so let me just kind of go through here and toss and thinkorswim. I'll set one up on 36 days out. And I'm looking here at about a 26 delta strangle. And so I'm going to sell this guy at a 31 put. See that 26 there? That's a 26 delta. And I'll look down here and then find the closest delta here. There's a 30 delta. So I'm going to sell that guy. So now let me go here and hit the analyze trade and just kind of show you. This is a little bit of a skewed strangle because I couldn't get the exact delta that I'm looking for. But let's see, April 16th is the expiration. So I'll put this on the 17th. So when I align these numbers, these two dotted lines up here, it shows me that this trade has a 62.35% probability of profit. I like those numbers. Brandon, if you were playing pot limit Omaha and you knew you had a 62.35% probability of winning a pot, what would you bet?
The pot.
You'd bet the pot. You know, you'd get your money in, especially if there's several other people in the pot, right? Because you'd have good pot odds. So here's a 31 to 36. So really what I'm hoping happens is by April 16th that the current trade is in between 29.50, my break even point, and 37.55, and GDXJ is currently trading at 47.19. Sorry, wait, that's EWZ, isn't it? GDXJ. Put an EWZ trade on, right? So let's go to GDXJ then, and I'll put one on there. So look here, and here's a 29 delta. I'll click on sell at 44 and look at 29 here. And here's a 30. I'm going to click on sell here. So I'm going to click on analyze that trade. Line these guys up. This number is always today's date. This number up here is of April 17th. So I'm going to change this date to April 17th. April 16th. So this has about a 63.18% probability of profit. You know, if I change these numbers a little bit, you can watch what happens to the probability. So let's change this one to 47.5 and this to 42. You can see how the probabilities change. So let's do another one. Here's one for the rut. So if I click on trade and I put one in for the rut, which is the Russell 2000 index, and I'll go ahead and I'll click delete here, go down into April, that's the AMs. April 9th. Yeah, Nancy, you made a mistake by trading an AM one time. You remember that?
Yes, yes, it costed me.
Yeah, it cost you. That was an expensive lesson. Look, this is a high priced one, but let's say sell that 30. Rut is expensive here. It's going to take us a considerable amount of buying power. Sell here. So let's do one contract. And if we were to do that in the rut, it'd cost us 36,000 in buying power. So it's a bit, it's larger than what, because it trades at 23.38 per contract. So that would be an expensive one to put on. So let's, if we got a smaller account, let's go to QQQ and just show kind of what it would be going down. But you kind of get the idea. You're selling the 20 to 30 delta, put, and the call. So 10 contracts here would cost you 50,000 in buying power. That's too much. So let's do just one contract here, and it would that's more affordable. 5,085 in buying power. I'll go in to analyze this trade. So the most you could make on this trade is $920 per contract here in the QQQ. So that is essentially a strangle. Now, let me also explain kind of what do you do with a strangle if it goes against you. And so what I mean by going against you, you could assume that this is the price, and price is fluctuating here, but it goes up and it tests your call side. So it goes up and it starts to get here around 340. So QQQ is currently trading at 318. So it's trading around here, and it goes here around 30 to, and then all of a sudden it starts hitting up against, getting close to this call side. What we're going to do is we're going to roll up the untested side. Now I'm going to define what the untested side means. If it's testing this side to the right, this is your untested side. If it's testing the put side, then this is your untested side. So you're always rolling up or down your untested side, turn your strangle into a straddle. So later I'll cover that a little bit more to kind of give you the gist of it. So let me also demonstrate it in trade diff, and I'll pull up trade diff and $1 million account, and I'll put a trade on. Somebody give me an example of a trade that you might, you're not bullish or bearish, but you'd be neutral on this stock. And those of you who have installed the scanner can use Sosnoff's settings to look at the most liquid ETFs or the most liquid underlyings. So give me an underlying that you might be neutral on.
Can it be a penny stock?
No, make it something that's highly liquid.
Microsoft.
Microsoft. All right. So I'm going to click Get Chain here. I'm going to put on a strangle here in Microsoft, and I'm going to do it 36 days out. That's my favorite sweet spot, is 30 to 45 days out. So yeah, I'm going to.
I'm sorry, I don't mean to interrupt.
Share that screen.
Did he freeze?
No. Maybe you did. Can you see the screen now?
Yeah.
All right. So I'm going to sell this 25 delta is put is at 225. And I'm going to go down here and find something comparable to 25. Here's a 26.4, and we'll sell the call there. So we're selling the 225 put and the 250 call, and Microsoft's currently trading at 237.45. So what we're doing is we're collecting $17.30 in theta decay for the next 36 days. So I'm going to then click, it takes about 26.93 in margin for that. And I'm going to go ahead and click submit. So I've now demonstrated kind of what it looks like in toss and what it looks like in trade diff. And what questions do you have?
Can you run through that one more time? I'm sorry, man. I apologize.
Yeah, you're selling a 20 to 30 delta put and a call. So Chris, you've already sold naked puts. You've already sold naked calls. So now you're putting it together in one trade and you're selling both a put and a call in the same underlying.
And hope that it does not go above or below those numbers.
In your hope that it stays between those two prices.
And you can exit this trade anytime,
You
right?
can
You
exit
take money
this trade anytime. So I think this will help you to visualize it. So, you know, we just put on a trade in Microsoft, right? We sold over here a put, we sold a call over here, and anything
We still can't see your screen.
anything that trades so what you did is you sold a put in Microsoft here, you sold a call in Microsoft here. Anything between now and expiration, you want the price to close somewhere in between those two. And if that's the case, you keep the entire credit collected. Now, Chris, you wanted me to put the entire trade on again? Chris, you're muted.
Maybe you wanted to see the trade grid set up.
I did want to see the trade again. I apologize.
Okay.
Said it was slow.
All right. So here I'm going to put the trade on in Thinkorswim, and then I'll put the trade on in trade diff. So here's in Thinkorswim, you're looking for the 20 to 30 delta. I'm trading QQQ. Expiration is April 9th. I'm looking at 20 to 30 delta. I look up here, I find something here that's 27 delta is a 303 strike on the put. So I'm selling the 27 delta. Let me look at something comparable on the call side. Here's a 27. I'm selling this guy. So this is kind of the risk graph. So you can see here, the purple is kind of what I would make if I closed it today. The green is what I would make if it's at that price at expiration. Now, I'm going to come over here to the $1 Million Challenge and put a Strangle on in trade diff.
It's not showing up on our screen.
Yeah, I got to drag it over there. Just a second. Chris, give me an underlying that you might be neutral on.
Salesforce, SFDC.
SFDC. Click on Get Chain. Salesforce have options. It's not bringing it up, so I'm not sure that they have options. SFDC. Sure,
Yeah.
that's the stock symbol.
No, it's AppFolio, APPF.
PPF. Now, I probably wouldn't trade it because of the liquidity, but I'll go ahead and show you kind of putting it on for demonstration purposes. Because look at the difference between the bid and the ask, you know, $1.20. So I'm going to go ahead and put this on just to show you, but this is the, you know, you're getting in a Bulgarian cab wearing a Chicago Cubs and you don't speak the language. So you're getting taken here. So we'd sell that one at the 24 Delta and sell this one at the 28 Delta. So that's a strangle. Does that help, Chris?
The 28 Delta, 28. Okay, gotcha. Yep.
It's 20 to 30 is kind of what our sweet spot is. I try to find one that's exactly the same, but that's as close as I could get in that underlying.
Gotcha. Thank you.
You're welcome. So we've demonstrated a strangle in both trade diff and on demand. Now what a straddle is selling both a put and a call at the money. I wanted to go ahead and teach it to you. It works well in extremely high volatility. It's not my favorite trade, but it's also, I'll go from a strangle into a straddle in order to make an adjustment. So how to manage strangles. You roll the untested side. Now, what is the untested side? The price is going up here and it's hitting up against your call side, which means it's getting closer than what you want. So now all of a sudden, this trade is no longer a neutral trade. It would be, if it's hitting up against this call side, now all of a sudden it's a bearish trade. If it's hitting up against the put side, it's a bullish trade. Now, what do you do? How do you manage that if it goes against you? Is you roll the untested side and turn that strangle into a straddle. So let's assume the price of your underlying is trading at 50 and you've sold the 40 and you've put and you've sold the 60 call. And it goes against you and it's hitting up against the 60. So it's now 59. What do you do with the put side? You roll the put from 40 to 60. So now you've got a straddle. And the reason you do that is now all of a sudden it neutralizes the trade again, which is what you wanted from the beginning. Your goal is to take a losing trade and turn it into a scratch or a small winner. It might take your win rate from 70% to 75 or 80 with the rolling strategy. If it still moves against you, you can go inverted. You could take the long or the short and sell premium against it, or you could close and take the loss. You know, and there's no real way to get around learning these things except to try it, right? And so let's go back in time and look at, I'll go into trade here and I'll click on demand. And I'll go back to, before COVID, say January of 2019. We'll just pick like a random date. And this is something that you guys could do as you practice kind of practicing a particular trade. So I'll look and I'll find a strangle that I could actually sell it and kind of go through. So I've got $100,000 in this account. It's January 3rd of 2019. I'll make it easy. I'll just sell something in the QQQ. So I'm going to go here and I'm going to pick a 30 Delta. So I'm going to sell this guy, go to 30 Delta.
The other way, Dale.
Thank you, 30 Delta. Confirm and send. $6,000 in buying power. That might be a little more. So let's just dial this down to about 5 contracts. Reason this is not trading is it thinks it's past midnight. So let's turn this to 10 a.m. But those of you who use Thinkorswim could actually go in here, use this on demand and practice trades like this. So then it executed. So let's kind of go in time and kind of watch how this thing performs. So you know, it's now January 3rd. Expiration here is the 15th. So let's just kick this a week and see what happens. So it's like January 10th.
Yeah, so when do you close it?
When do you close it? Well, Tasty Trade would recommend that you close at 50% of max value. So 50% of the credit that's collected. So let's see what this has done. It must have gone against us a little bit. It's 160.46 is QQQ is what it's trading. So let me go into the Analyze tab and see what this QQQ is doing. So QQQ is trading at 160.44. So it's blown past the call strike. You see that?
Mm.
So it's now, what I'm trying to teach you is you roll your untested side. So which side is the untested side?
The put.
The put. So the call has been, it blew past the call. So what we're going to do is we're going to take this 142 put and we're going to roll it to 158 and turn the strangle into a straddle. You follow me?
Mm-hmm.
So, okay, I'm going to click on create rolling order. We want the same expiration of February 15th, and we're going to roll it to 158. So this needs to be 158. So I'm collecting another credit for that, which is $3.12 multiplied by 5, which is about $1,500. Okay, so now I have a straddle. So I'm hoping to turn this into a scratch or a small win. So now it's January 10th, and let's kick it up a week and see what happens. So we'll go to the 17th, and we'll see what our P&L does. The only reason I did this was not to show you about the profitability of a strangle, but to give you an example of rolling the untested side. So we went from about a $600 loser to about a $137 loser. So let's kind of go from the 15th. Now it's the 17th. So let's roll it out a week. Now see what happens. So a week passes. So now we're at a $260 winner. So we took something from a loser by managing it and we turned it into a winner. So there we go. I just wanted to demonstrate kind of rolling the untested side, and that's what it means to roll the untested side. So I've told you about it. I've demonstrated it. So your assignment, should you choose to accept it, is to create 2 to 3 strangles and then put them into categories. What questions do you have?
None.
We're going out 30 days on that or 45?
30 to 45 is my magic point, but I prefer to trade the monthlies over the weeklies, mainly because of liquidity.
Okay.
So what I do is I go to the next monthly. So what I would do is I'd be trading the next April monthlies. All right, what other questions do you have? Chris, I think you're saying something, but you're muted.
I said 30 seconds of silence, but I think
Oh, that's it? All right. Well, this is an undefined risk trade. Next week, we'll learn how to do an iron condor, which is just buying the wings. So you turn an undefined risk trade into a defined risk trade. It affects a little bit of your probability of profit, a little bit of your profitability, but it has less risk to it. By the way, Strangles is actually one of my favorite trades, and I like to do the trade around earnings. It's risky around earnings, but the benefit of risk is that you get paid. And there was a quote that I thought I'd pass along to you guys this week that I got, and I like this quote: "For every gimme, there's a gotcha." Which means every time there's a benefit to something, there's also a potential downside. And so the benefit of Strangles is that they can be highly profitable and good probability of profit. The gotcha is it's an undefined risk trade. So you don't want to put too many on, because, all in a huge down move or huge up move, your account size can't take a lot of these things because they're thermonuclear. You could blow up an account. All right, guys, I will be here till the last person leaves. If you want to kick around, shoot it, chat about what's going on, I'll be here till the last person leaves. And then I'm going to go ahead and stop the recording now. And thank you.